Welcome to lesson 4. We're going to be looking at technical analysis part 2. And in this lesson, we're going to be covering things like technical indicators, candlestick patterns, and market and sector analysis, just to name a few. So let's begin by understanding how to use technical indicators. So far you've learned about how to read trends, right? Uptrends, downtrends, and consolidations. You've looked at moving averages that help us to determine the change in the trend. And we also looked at support and resistance levels. So to help us further to fine-tune our entry points, we can use technical indicators. So if you look at any kind of charting software, there are hundreds of indicators that traders can choose and use. And these are a couple of them which are listed over here. And I don't know half of them, so it's not really important. And what are these indicators? These indicators are, by nature, they're all lagging indicators. What it means is that they are calculated based on historical price data. Okay, so there's no indicator that can predict where price is going to go. It just gives us a probability of anticipated price movement based on historical data. Okay, now there are two kinds of indicators basically. We have trend following indicators that tell us the strength of a trend. So like the price could be on an uptrend, but how strong is the uptrend, right? Indicators help us to determine how strong it is, or how strong is the downtrend. The second type of indicators would be oscillators that measure if the price is temporarily overbought or temporarily oversold, right? Because this assumes that price oscillates between a mean. So again, helps us to fine-tune our entries. Now, what is important is that indicators should never be used in isolation. They must always be used in the right context of the right trend, okay? And they must be used in the right combination. So you're gonna learn about some of my favorite indicators, but you can't use them by themselves. They must be used in the context of the right strategy. So when we go into the lesson plan on strategies, you learn, okay, for this particular strategy, which indicators do I use? And for that, which one do I use? Okay. So right now it's understanding the individual indicators and what they do in the first place. So let's start with the first one, MACD. MACD is the most commonly used indicator. Most traders use it, right? It's called the moving average convergence divergence. Okay. Now this is a trend following indicator that tells us how strong a trend is. How bullish is the uptrend, how bearish is the downtrend. How's it calculated? It is calculated by using two moving averages. The 12 EMA and the 26 EMA is commonly used, although we will use others for different strategies, okay? Now, the MACD line, which is this black line you see over here, let me just zoom in. Can you see this black line over there? This black line? Okay, that's the MACD line. So notice this is the price chart, and below is the MACD indicator. So the first thing to look at is this black line, and that's the MACD line. The MACD line is plotted or calculated by subtracting the two EMAs against each other, right? So subtracting the 26 EMA from the 12 EMA, you get that black MACD line, okay? And then you take a 9-day exponential moving average of that MACD line, and you plot it on top of the MACD, and you get this red dotted signal line. Okay, so that's how these two lines are created, the MACD line and the signal line. Now, if you're not a numbers person and you're confused, how is it calculated again? It's not important, right? It's like you don't know exactly how electricity works, some of you, but you still use electricity. You just have to know when to switch on and switch off the switch, okay? So simply this is how it's used, all right? We look at the relationship between the MACD line and the signal line, okay? And here's how it goes. Basically, when the MACD line, in this case it's black, right, crosses above the signal line, we have got bullish momentum. Okay, so it tells us that the momentum is moving up, right? So obviously, if we want to go long, the best time to go long is when MACD is bullish, and obviously we don't want to go short when that happens. Okay. Similarly, when the MACD line, in this case, crosses below the signal line, below the red line, MACD is bearish, or momentum is bearish momentum. So that's an ideal time to go short because the probability is that prices will continue going down. Okay, so you can just take a look at the black and red line, or you can look at the histogram as well. All right, so in this case, you can see a black histogram or these black bars, and the red histogram or the bearish bars. Okay, now notice when the black line is above the red line, we have the MACD bullish histogram. And when the MACD line crosses below the signal line, we have the bearish histogram. So you can either look at the two lines or the histogram. Okay, they both tell you the same story. Basically, when histogram is bullish, momentum is bullish. When histogram is bearish, it's red, momentum is bearish. Okay, so we will use the MACD in some of our strategies, especially the trend following strategies like the bounce. Okay, so stay tuned to that. So just understand what MACD does right now. So MACD is my favorite trend following indicator, once again, to tell me how bullish a trend is or how bearish. My favorite oscillator is the stochastics oscillator. All right, and again, what's an oscillator? An oscillator is an indicator to identify if the price is overbought. That means it has moved up too fast, okay? Or it is oversold, it's moved down too fast. Because if it goes up too fast, what happens? It tends to come back, all right? If it goes down too fast, it tends to come back as well. So take a look at this price chart. You can see that the price is on an uptrend. It's making higher highs, okay, and higher lows. So that's how you know it's an uptrend, as you have learned previously, right? So notice that on an uptrend, prices don't go up in a straight line, right? What happens is they will go up, but once they reach a certain point, they have to come back down again before going higher, come back down again, going higher, going down again, right? So when price goes up, it goes to a point where it's a bit overstretched. It's like overbought. It's got to eventually come back to the mean, okay, the center. And sometimes it goes way below the mean, it gets overstretched, you can say oversold, it snaps back. So think of a stock as kind of like a pendulum, right? It oscillates between a center mean. So the stochastics oscillator is an indicator to tell you, hey, is it overstretched to the upside, looking to come back down, or overstretched to the downside, looking to come back up, okay? And again, you can't just use this oscillator by itself. It must be used in the context of understanding where the trend is in the first place. So in this case, you can see it's an uptrend, all right? And an ideal time to buy would be when? When the price is oversold on the uptrend, right? Oversold means it's gone down too much. It's bound to bounce back up. But the overall trend should be bullish in the first place, okay? So let's take a look at how to read this indicator, okay? So typically, this is how the stochastics indicator looks like once you insert it into the price chart, okay? For those of you who are maths geeks and you want to know, okay, how is this calculated? That's how it's calculated, right? We've got the fast percentage K line, the full percentage K line, and the percentage D line. And this is a specific formula that's used to calculate these lines, all right? And again, you don't have to understand this purely for entertainment purposes, intellectual entertainment. But if you just want to make money, you just have to read how the lines move. So I'm not going to go into detail about really the math behind it, but I'm just going to show you how I use it, okay? So what you see here is you see, first of all, two boundaries. The upper boundary and the lower boundary, okay? So two boundaries, okay? And the upper boundary is measured at 80. So this is the 80 line, 80, and that is the 20 line, okay? So, and you notice these two lines moving, right, between these two boundaries, okay? So when these two lines get above the 80 line, what does it mean? It's above the upper range. That tells you that the price is overbought. Okay, overbought, overstretched to the upside, likely to come back down. Okay, when the two lines are below the lower boundary, like here, below 20, it's what? Overstretched to the downside, it's oversold, looking to bounce back up again. All right, so we're always looking at these two lines, and the two lines, by the way, they're called the percentage K and percentage D lines, which you can see that they are brown and they are blue. Okay, so once again, I'm looking for the lines to go either below 20 or above 80, and those are signals that price is overstretched, waiting to move in the other direction, right? So how do I use it in the context of the trend? Well, let's take a look. So over here you can see the chart of Apple, right? And Apple's on an uptrend. Okay, now how would you know it's on an uptrend? Well, first of all, you can see that the price is above the 50 moving average, which is in blue. And you can see the 50 moving average is sloping up. So it is on a medium term uptrend. Excuse me. And the 50 moving average is also above the 100 moving average. Okay, so clear uptrend based on the moving averages. And what you see here is that the price on an uptrend is making a retracement, right? It's kind of like dipping before it could potentially continue the uptrend. Okay, so the question would be, okay, it's making a retracement. So how do you know it has retraced enough before continuing the trend? Okay, so one way is you've learned to look at support. The moving average acts as a support, right? So when the moving average goes, or rather the price goes to the moving average, what happens? It finds support at the moving average, okay? So what traders do is they look at the price coming to the moving average, hitting the moving average, they're waiting for a bounce before buying, okay? So to give us added confidence that the price has retraced enough that is going to now continue up is by using the stochastics. Okay, so notice that when price retraces to the moving average, we want to see the stochastics below 20 ideally, because this tells us that the price is oversold, it's overstretched at the support level on an uptrend. Okay, so that's the best time to actually buy. Over here you can see that it retraced again back to the moving average, but stochastics was not really below 20, so this was not overstretched enough. This would have been a better entry for a long. Okay, here's an example of a short. All right, so over here you can see that price is on a clear downtrend because moving averages are sloping down, right? The 18 EMA is below the 50, the 50 is below the 100, below the 150. So you've got that EMA fan you've learned about earlier, right? So the fan is going down, it's a downtrend, and price is making, obviously you can see, lower highs, right? Making lower highs, very nice wave pattern. And over here, what has happened? The price has rallied, okay, after it went down, it rallied, and it's hitting that 50 moving average, which acts as a resistance, okay? So it hits the moving average, it's going to come down. That's when we want to sell and ride the rest of the trend down. So again, how do you know it's the top? I mean, you never know, but a good indication is that it hits a moving average. Plus, what do you see? Stochastics is above 80, right? That tells you that the price is overbought, it's overstretched. Okay, so the best time to short a stock is when it's overstretched, it's overbought on a downtrend, hitting a resistance level. So we've got a confluence of many factors. Hits a resistance, it's overbought, it's on a downtrend, boom, we go in for the short. All right. So that's how we actually use stochastics to give us a better entry into the trade. All right, great. Now the other indicator which I use a lot of, especially in counter trend trading, are the Bollinger Bands. Okay, so Bollinger Bands are another indicator that's also used to indicate oversold and overbought conditions. They can be used together with the stochastics or by themselves. Okay, Bollinger Bands are also useful as support and resistance levels, and by default we use the Bollinger Bands 20 SMA with 2 standard deviations. Right? It's a default setting on most software. So let's take a look how to use the Bollinger Bands. Right? if you take a look at the price of Coke, you can see that more or less moving sideways, okay? And you can see the Bollinger Bands being plotted, right? It's this upper line and the lower line. So this is the upper Bollinger Band, kind of like an envelope, and the lower Bollinger Band, lower envelope, right? So the price kind of like is contained between these upper and lower bands, okay? Now, notice that these bands act as support and resistance, okay? So the upper band acts as a resistance, 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 right? So, sometimes the price goes up, hits the upper band, comes back down again. The lower band acts as support. Can you see support level, right? So that's one way we use Bollinger Bands. Again, you can't just use them by themselves. In the specific strategies, I'll show you when to use Bollinger Bands, okay? And again, when price is when the price tends to go outside of the Bollinger Bands, like so, you can see that it's moving outside the Bollinger Bands. What does it tell you, right? The price is outside of its normal range, outside of its normal standard deviation. So it's overbought, right? When it's overbought, tendency to come back down again, all right? So in counter trend trading, we tend to short the stock when it's outside the upper Bollinger Bands. But again, we can't use it by itself. We have to combine it with other things that we're gonna look at, right? Like candlestick patterns, for example, okay? And over here, you can see what happened. The price is outside the lower Bollinger Bands, outside the lower Bollinger Bands. So again, it's outside the normal range, it's oversold, tends to snap back, okay? So these are how we use Bollinger Bands, support resistance, oversold, overbought conditions. So here's an example of a counter trend trade using Bollinger Bands. And you can see that the price, what has happened over here, right? The price has gone up and it has formed what we call a bearish pin bar. Okay, you're going to learn this really shortly. A bearish pin bar, a bearish pin bar is a bearish candlestick pattern. Okay, and you can see that this bearish pin bar appeared outside the upper Bollinger Bands, telling us that it's again overbought. All right, it's outside the normal range, so it can't stay outside for long. It's going to come back in again, right? So that would have been a short entry, going short, taking a quick profit as the price went back into the bubble, went back into the Bollinger Bands and near to the moving averages. Here's another example of price, right, going down, and what has happened? That's right, it went out of the lower Bollinger Bands, and again it forms what we call a bullish candlestick bearish pin bar. All right, so again outside the lower Bollinger Bands, it's overstretched, it's oversold, and tendency for it to revert back to the center of the bands. All right, so these are my three go-to indicators, right? Trend following MACD, oscillator full stochastics, as well as the Bollinger Bands. So now let's take a look at candlestick patterns. Alright, so let's jump into the lesson on candlestick patterns. So if you use any kind of charting software to analyze a stock, notice that price is represented with candlesticks, and this was first invented by the Japanese 400 years ago, but it's the most common way we analyze stocks for most professional traders. So for example, if you were to key in a symbol like Facebook, right, and you click go, you will get Facebook's price reflected on candlestick charts. Okay, so these are what we call candlesticks. All right, and in this particular case, we are looking at D, or daily candle. So each candle represents a day. So this is 1 day, 2 days, 3 days, 4 days, and so on and so forth. And well, the first thing to notice is that some candles are white and some candles are red. White candles are known as bullish candles, and red candles are known as bearish candles. And we're going to learn how to read them specifically in a short while. And also notice that candles have different shapes and sizes. Just like people, right? Some of them are fatter, some are skinnier, some are taller, some are shorter, some have a long upper shadow or tail, some have a long lower shadow of tail. And all this tells you about the psyche or the sentiment of that day, right? So was it a bullish day? Was it a bearish day? Who took control of the day? Was it the bulls or the bears? Okay, and on the price chart, like I mentioned, you can look at it at different time frames. For example, in this case, we're looking at it in terms of daily candles. So usually in swing trading or in short-term trading, we use daily candles, okay? But if you're going to intraday trading, which we will be doing in the level 2 of the professional stock traders course, we'll look at, for example, 5-minute candles. So if I go to 5 minutes, you notice that in this case, we're looking at an intraday chart. So from here to here, this is 1 day, right? 24 hours. Well, not really 24 hours, but from 9:30 a.m. to 4 p.m., that's when the markets open. And in this case, you can see that these candles are 5-minute candles. In other words, each candle represents 5 minutes. Every 5 minutes, the candle closes and a new candle opens. Okay? We will even zoom in to 1-minute candles as well. All right? This is a 2-day, 1-minute candle. Right? So if I zoom in, you can see that each of these candles represents 1 minute. Right? It's 1 minute, 2 minutes, 3 minutes, 4 minutes, and so on and so forth. Now, whether you look at candles on a 1-minute time frame or a 5-minute or daily time frame, the way you read their patterns is similar. All right. So if you take a look at Facebook, for example, you can see that. Let me just zoom out. From here all the way to here, this represents 1 day. Okay, so you can see in 1 day there were many 1-minute candles, but this entire day is represented through 1 candle, right? So what do you think this candle looks like for the daily candle? Well, it opened here, right? It went to the low here, and it closed over here, right? And it made a high over there. So it was definitely a bearish candle, right? Because it opened high, it closed low. Okay, so it's definitely a red candle. So in fact, let's take a look. If you go to the daily candle, 6 months daily candle, sure enough, you can see that indeed it was a bearish candle, right? So it opened over there, it closed here, that was the high and that was the low, right? So all those 1-minute candles you saw made one big gigantic daily candle over here, all right? So how do we read these candlestick patterns, and what do they tell us about the trend, okay, or whether we should take a bullish or bearish entry? Let's take a closer look. So let's take a closer look at how we read these candlestick patterns, right? Now, candlestick charts are important because they tell us 4 things about the stock's price. It tells us the opening price, the closing price, the high, and the low price of that day or that period in the case of 5-minute candles, right? So let's take a look at daily candles, right? So in the context of each candle represents a day. So you either have a bullish candle or you have a bearish candle. And bullish candles are represented by a white or green candlesticks usually. And bearish candles are represented by red candlesticks or black candlesticks, okay? So whenever you see a white candle or green candle, it tells you that it was a bullish period or bullish day for a case of a daily candle. And how do you read a bullish candle? Well, here's how you read it. This part over here is the opening price, all right? So for example, the price may have opened at $5. And over here, we have the closing price. Say it closed at $6. So it opened at $5 and it closed the day at $6. And the opening and closing price, they form the body of the candle. All right, so the body shows you the opening price and the closing price. But during the day, the price may have gone to a certain high of, say, $6.50. So that is the day high. And it's represented by an upper shadow or an upper tail, if you will. Okay? And the price went as low as, for example, $4.90. That's represented by the lower shadow. Okay? So simple enough. When you see a bullish candle, how do you read the candle? Well, open. The opening price is at the base of the body of the candle. The closing price is at the top of the body of the candle. The high is at the upper shadow and the low is at the lower shadow. Right? So if you see a bearish candle, you would read it the other way around. For a bearish candle, the opening price is at the top of the body. Okay, so this is the opening price at the top of the body. This is the closing price at the base of the body. The day high is similarly at the upper shadow, and the day low is at the lower shadow. All right, so you see a bearish candle is open, close, high, low. Bullish candle, open, close, high and low. All right, so as earlier mentioned, candlesticks come in all shapes and sizes, right? And there are different names given to the different shapes of candlesticks. I only pay attention to a couple of these shapes because these are the ones that I use the most often. They're the most reliable, and they produce great entry points when we go long or go short. Okay, so there are basically four kinds of patterns that we're going to look at: the pin bar pattern, the one white soldier and one black crow pattern, the morning star and evening star, as well as the bullish and bearish engulfing pattern. All right, so let's take a look at the first one, which is the pin bar pattern. As the name implies, it looks like a pin, right? You know, poking someone with a pin, right? So the first one is known as a bullish pin bar. Okay, so whenever you see a candlestick that looks like a pin bar, well, it's a pin bar, all right? And the first one is known as a bullish pin bar. Now notice that for this pattern, the color doesn't matter. It could be a white candle, could be a red candle, right? The reason is because for this pattern, the body of the candle is small, so it doesn't really make a difference, okay? Hence, I use black. So black represents anything, right? Or white or red, doesn't matter, okay? Now, for this specific candlestick pattern, there are a few conditions that must be met, okay? First, the body of the candle has to be small, right? Just like a pin has a small body, so does this candlestick pattern, right? Next, there's little or no upper shadow, right? So notice that these four candlesticks are all bullish pin bars, right? So 1, 2, 3, 4, they all qualify. Now you can see that all four of them have small candle bodies, right? Small bodies, as opposed to the ones with the big candle bodies. These are very small candle bodies. In fact, you can see that for these two examples, the candle body is just one line because the opening price and the closing price is the same price. So hence, you got a line. That's it, right? And there's no upper shadow or a very small upper shadow. Now, the most important thing is that we want to see a long lower shadow for it to be a bullish pin bar. Now, what is long? Long means that the lower shadow has to be at least 2/3 the range of the candle. Okay, now what is range? Range is the distance from the top of the shadow to the bottom of the shadow. So from here to here, that's the range, all right? From here to here, that's the range. From here to here, that's the range, okay? Now out of the entire range, I want the lower shadow, which is from here to here, to make up at least 2/3 the length of the entire range. So that tells you that it's got a long lower shadow, right? So why is this a very powerful pattern? Because when you see this pattern, it tells you that the bulls or the buyers have taken control of that stock for that day. So there's a high probability that the price will reverse up the following day, and that's when we go long, okay? Now, it's important that this bullish pin bar appear at the right context. I mean, it can't appear off in any situation. It's going to appear in the right context. Now, what do I mean? it has to appear after a series of bearish candles. Okay, so what you want to see is you want to see the price coming down, all right, over a series of bearish candles like that, right? So you want to see many candles coming down, okay, and these candles are, you know, making lower highs and lower lows. And after a series of bearish candles, you see one of these bullish pins. So you want to see one with a small body and a long lower shadow. Okay, so when you see this, what does it mean? That's right, there's a high probability the price will reverse back up. So that is a point where we want to buy or go long. Okay, so why does this work? What's the psychology behind that market? Okay, so here's how I explain it. So what it tells you is this: on this day, the price may have opened here, for example, right? The price opened at the body of the candle, right? And what happened was that after opening here, the bears started selling, right? So it pushed the price down. So the price went down, 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 all the way down. And everyone thought that it's going to go down, right? But what happened? Halfway, the bulls started taking control. The buyers started buying, 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 and pushing the price up, and finally closing the day really near the open of the candle, which means that what happened? That's right, the bulls took control of the market and closed that day. So this tells you that the bulls are in control. So basically, whenever you see candles with long lower shadows, it tells you that the bulls have taken control, and there's a high chance the price will reverse back up the next day. Now, this ideally happens when it's at the support of an uptrend. Okay, so in other words, you want to see that the overall trend is up. For example, it's an uptrend like so, right? Up, down, up, down, up, down, right? So this is an uptrend, as you recall, higher highs and higher lows, right? Now, as the price is coming down over here, making a temporary retracement, we want to see a bullish pin bar appear over here, right? Ideally at a support level. So it should be at a level of support, like a moving average or trend line. When we see a bullish pin bar appearing, there's a high chance the price will continue the trend. And we call this a trend trade, right? Trading with the trend, okay? At the same time, this pattern could also appear at the bottom of downtrends when the price is oversold, right? So an example would be the price is on a downtrend like so, okay, on a downtrend, and then it goes through a sudden plunge over here. And right at the bottom of that plunge, that's right, we see a bullish pin bar, okay? And it's got to be oversold, right? How do you know it's oversold? Well, you can use the Bollinger Bands, for example, if the price is outside the Bollinger Bands or near the lower Bollinger Bands, or if there's some kind of support level, that adds added conviction that, hey, we've bottomed, right? And the price is likely to reverse up. So we start to go long once we see that. So that's a bullish pin bar. Let's take a look at how it appears on the charts. All right, here we go. So this stock is Zebra Technologies, and you can see that it's on a clear uptrend over here. All right, the 50 moving average is above the 150 moving average, and the price is above the moving average, okay? So you can see up, down, right? So you can see making higher highs over there, higher highs, higher lows. And over here, what has happened? Notice that the price is making a retracement, right? It's going down, going down, going down, and boom, what do you see? You see a bullish pin bar, right? There you go. You've got a small candle body, long lower shadow, small upper shadow. And not only that, but it is resting on the moving average. Okay, so that gives us even more confidence that, hey, you know what, it's a bullish pin bar, the bulls have taken over, we're going up, and it's at a support level, right? So usually when you see that, what can you do? Prepare to buy, right? So usually we put a buy order a few cents above the high of that candle. You can put a stop loss a few cents below the low of the candle. So the next day, if the price goes up, as we anticipate, what's going to happen is going to trigger our buy order. We're going to buy over here, right? Buy over here with a stop loss over there, and boom, the price goes all the way up. And that's a really great trade, makes us a good profit, right? So in this case, the bullish pin appears at the support level of the uptrend, right? And the support level is the moving average. That is the ideal time when a bullish pin appears. Again, if the bullish pin appears out of nowhere, like it appears somewhere here, okay, imagine there's a bullish pin here, well, it's not very powerful. Why? Because, remember, a bullish pin should appear after, that's right, candles going down, like so, right? Candles going down, it appears, right? Candles going down, there you go. There's another bullish pin bar. Can you see that? All right? So it goes down, pin bar, goes down, pin bar. In this case, if it appears here, it didn't appear after candles going down. So this will not be very reliable. At the same time, you can see that this bullish pin bar is hitting a level of support or the moving average, right? It's hitting the moving average. But this one is kind of like suspended in the middle of nowhere. It's not hitting any kind of moving average. So I'll be cautious to want to buy if I were to see it over here. All right. So again, the bullish pin bar has to appear at the right context. Okay. Here's another example. So in this example, the bullish pin bar appears at the bottom of the downtrend when the price is oversold. Okay. So again, you can see the price is coming down. Right, bearish, 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 bearish. Bears are in control, and on this day, what happens? The bears attempted to push the price down, 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 and then halfway, the bulls took over. The bulls started buying and buying and buying and buying and buying and buying, and closed the day up there again. So it tells you that with the long lower shadow, the bears were winning, but they lost the battle, right? So that tells us that the price is likely to reverse back up. Okay, and that's where we could put a buy order just a few cents above the high of the candle and a stop loss just below the low of the candle, right? Now, again, ideally, I would like this to appear at the support of an uptrend. But in this case, it's appearing on a downtrend, okay? So if I were to buy it here, what's happening? I'm trading against the trend, right? It's a counter trend trade. So I got to make sure that it is oversold, right? So to give added confidence, you could look at the stochastics that we learned earlier on. The stochastic should be oversold, right? Below 20, or the candlestick, it's cutting the lower Bollinger Bands, right? Some kind of indication that it's at a support level, it's oversold, and there's more confidence that it's going to bounce back up again, okay? All right, so let's take a look at the opposite of the bullish pin bar, which is the bearish pin bar. So the bearish pin bar looks similar, except that it's the flip side of the bullish pin bar. So what you have is, similarly, you have got a small body, all right, and a long upper shadow this time with a small or non-existent lower shadow. So any of these four candlesticks you see qualify as a bearish pin bar. So once again, a small candle body or no candle body whatsoever, just one line, very small or no lower shadow, but long upper shadow. And again, the upper shadow has to make up at least 2/3 of the range of the entire candle for it to qualify as being long enough, right? So again, finding a bearish pin bar on the chart is not good enough. You have to find it in the right location. And it should appear after a series of bullish candles. So what you want to see is a series of candles going up like so, making an upward move, right? And then you see a bearish pin bar appearing. And once again, the bearish pin bar, it could be a green or white or black or red bodied candle. It doesn't matter because the candle body is so small, it is insignificant. What you want to see is you want to see the shape of it. That's important, okay? So once you see that, there's a high probability that price will reverse, because what this means is that the bulls attempted to push the price up, right? They were buying and buying and buying, pushing the price up to a high, what happened is midday the bears took over and they sold and sold and sold and pushed the price all the way back down again to where it opened for the day. So in other words, the bears took over the sentiment of that stock, and likelihood is for the price to reverse downwards in the days to come. So when you see a pattern like that, that would be a time to sell, to close your long position, or to sell short to start a new short position. All right, and again, ideally they should happen at the resistance of downtrends. Okay, we call that a trend trade, or at the top of uptrends, where it's a counter trend trade. So let's take a look at a few examples. So in this example, you can see that the price is on a downtrend, on a clear downtrend, right? You can see that very clear downtrend wave pattern that's happening. Lower highs and lower lows. 50 moving average is below the 100, below the 150, below the 200. So you've got a very clear moving average fan on a downtrend, okay? And again, price goes down, retraces up, goes down, retraces up, goes down, retraces up. Now over here, what do you notice? As it retraces up, that's right, you see a bearish pin bar, okay? So the bearish pin bar appears after a series of bullish candles. That's exactly what we're looking for. And it is finding a resistance at the 50 moving average, okay? So the ideal time to short when you see a bearish pin bar is when it hits a resistance level, like a moving average. In this case, you can see that the 50 moving average has been tested to be a very strong resistance. You can see a bearish pin bar here as well that again resulted in a reversal of price. Price goes up, bearish pin bar, it comes down, again another bearish pin bar over here. So many bearish pin bars get rejected off that 50 moving average. Very nice down here, okay? So this is what we call a trend trade, because we're trading with the trend, we're selling on a downtrend at the rally, okay? This is an example of a bearish pin bar that appears at the top of an uptrend, okay? So when you do a short, you're actually trading against the trend. It's a counter trend trade. So on an uptrend, you can see the price goes up, retraces, goes up, retraces, and goes up. And sometimes it goes up too fast, it is overbought, right? It has to retrace back down again. So at the top of that impulse, you have got that bearish pin bar, okay? So again, when you see a bearish pin bar at the top of an uptrend, and you have got some kind of overbought condition, for example, stochastics is overbought, you know, it's above 80, for example, or you can see that it's hitting some kind of a resistance level, or it's cutting the upper Bollinger Bands. You want some kind of additional confirmation that it is finding a resistance, it is overbought. And when you see that bearish pin bar appearing, boom, you know that you can place an order to sell the stock, right? Anticipating a reversal in the price. So the sell order could be placed a few cents below that bearish pin bar, right? With a stop loss just above that bearish pin bar. And sure enough, the next day, the price goes down as we anticipate, triggers your sell order, and more or less collapses, right? Great. So again, in the strategy section, you're going to learn how to combine all these elements, right? Candlestick patterns, support and resistance, moving averages, trend, counter trend. And that's when you take a trade. You do not take a trade based on one isolated pattern, right? Like a candlestick or moving average. They have to all come together to form a strategy. So we'll go into that later in the lessons to come. For now, just understand the candlestick pattern, right? All right, so moving on from pin bars, we're going to look at what we call the one white soldier and the one black crow. So let's begin with the one white soldier. The one white soldier is a specific bullish reversal pattern that consists of two candlesticks, like so, all right? So it begins with a bearish candle followed by a bullish candle. So again, bearish candle followed by bullish candle. Now, here are a few rules, all right? The bullish candle must open above the close of the bearish candle and make a higher low, all right? So what you want to see is Again, this has to appear after a series of bearish candles. So what you want to see is bearish candles coming down, like so, right? So coming down, and at the end of that series of bearish candles coming down, first thing that should appear is the last bearish candle, right? So these are bearish candles, and you have one final bearish candle. So that is known as the swing low candle, right? Because it's at the lowest point. Yeah. Now, when you see a bearish candle, recall that this is the opening price at the top of the candle body. This is the closing price, right? And the top of the shadow, that's the high, and the bottom of the shadow is the low. Okay, great. Now, once you have that bearish candle, it has to be followed immediately by a bullish candle. Now, the bullish candle, the opening price is over here at the bottom of the body, right? So the rule is such that the opening price of the bullish candle must be above the close of the bearish candle. So that is the first criteria that must be met. Okay, that's what it says over here. Next, the bullish candle must make a higher low as compared to the bearish candle. So this low is higher than this low. That's the second criteria. The third criteria is the bullish candle must close above the high of the bearish candle. So in other words, this close, which is the top of the body, has to be above the high of this candle. So once all three criteria are met, you have a one white soldier pattern. Okay. Now this pattern is a very reliable bullish reversal pattern. In other words, once you see this pattern, after a series of bearish candles, you see this pattern, high chance the price will reverse. Okay, and we're going to take a long entry. Again, ideal time this appears is at the support of uptrends, of which if you take the trade, it will be a trend trade, or it appears at the bottom of downtrends when the price is oversold, and we call that a counter trend trade. So why does this work? Well, let me explain the psychology behind this pattern. So what happens is when price is coming down, people are selling, right? They're selling, 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 selling. And there's many of people who are selling to close positions because they're panicking, they're getting rid of their stock. Or it's made of people who are short selling. So they're selling, hoping it's going to go lower, right? So on this particular day, right, for example, well, let me use a different color, red. Okay, so after many days of selling, you have got this final day of selling where people are again selling, 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 they're shorting the stock, okay? Now what happens the next day? The next day, the price opens here. It opens above the close of this candle. So what it means is that all those people who shorted on this day, right? What's happening? They're shorting, they're hoping the price will go down. But the next day, the price opens above the close, which means all the people who sold at the close, they are losing money, right? Because now the price is above where they sold. So they're losing money, they're panicking. Now, when they panic, what do? They quickly buy back the shares to close their short position. And by buying back the shares, that adds buying pressure. So that creates more buying. And eventually, what happens? Eventually, the next day, the price closes, right? That's the close above the high of this bearish candle, which means that anyone who sold on this day, who shorted on this day, is now losing money because the price is above their short position. So they are panicking, oh my God, we're losing money. So what do? That's right, they start buying to cover their short position. And by buying, what happens? It propels the stock upwards, right? And that's why it works. Psychology, okay? So that's the one white soldier pattern. Now, let's see it appear in different parts of the charts. Okay, so if you take a look at this chart, take a moment and see if you can identify the one white soldier patterns. Okay, go ahead, take a couple of seconds and see if you can find any. Did you find any? Okay, there. That's an obvious one white soldier pattern. Can you see that? Is there another one? Well, yeah, this is another one white soldier pattern. Okay, so if you take a look at this one, let's see. Does this appear after this a series of candles going down? It does, right? So you can see that the candles are going down over here. They're going down, going down, going down, going down. They're selling off, selling off, selling off, and boom, you have got that last bearish candle, which is a swing low, and then boom, you have got that bullish candle, right? So once again, this opens above the close of this candle. Criteria number one. Next, this makes a higher low than the low of this candle. Criteria 2. Next, this candle closes above the high of the bearish candle. Criteria 3. So all three criteria are met. It's a one white soldier pattern. Okay, and you can see that this one white soldier pattern is appearing at the support of the moving average, right? So again, that is a very powerful pattern. Okay, you have a bullish reversal pattern appearing at the support level of a moving average. So high chance it's going to bounce back up. Okay, and it's on a clear uptrend, right? So you can see that we are buying the dip on the uptrend. We are following the trend. It's a trend trade. So when you see that, where would you put your buy order? I will put my buy order just a few cents above the high of this candle, a few cents above. And I'll put my stop loss a few cents below the low of this candle. So I'll buy over here. That's my buy order. That's my stop loss. Okay, and this will probably be like a 1R risk which I'm taking. And I need to hit at least 2R to make it worth my while. Right? So the next day, what happens? The price goes up as we anticipate, triggers my buy order, and boom, right? The price goes up and hits my profit target. I'm out, right? Over here, now this black candle is a bearish candle, okay? And again, this is a one white soldier pattern, right? And is it finding support at a moving average? Yes, it is, okay? So again, that would be a valid entry. So I'll put a buy order over here, a stop loss over here. Now the next day, what happened? The price never went above the high of this candle. So my buy order would not have been triggered, okay? So I would not have, taken the trade. Instead, it went down. So that's the beauty of placing your buy order just above the bullish candle, because only if the price goes up as we anticipate do we get into the trade. If it doesn't go up, we don't take the trade. All right. So this is an example of a one white soldier appearing at the dip of an uptrend, and we're following the trend. Now in this case, we see a one white soldier appearing at the bottom of a downtrend. So by buying, we are trading against the trend. It's a counter trend trade. But we're buying when it's oversold, when it's ready to bounce back, right, from oversold conditions. So can you identify the one white soldier pattern? Can you find a one white soldier pattern? There it is, one white soldier. Okay, so once again, you want to see a sell-off, right? Price going down, sell, 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 sell. And this is the last bearish candle to make a new low, right? Now, that bearish candle in the one white soldier must be a new low. It must be the lowest point of the price, okay? And following that, we have got a bullish candle. So let's take a look. Does it meet our criteria? Criteria 1, the bullish candle has to open above the close of the bearish candle. Check. The bullish candle must make a higher low than the low of the bearish candle. Check. The bullish candle has to close above the high of the bearish candle. Check. Check, check, check. All three criteria are met. We have a one white soldier pattern. Okay. So once you have that, you put a buy order just above the high of the candle. Stop loss just below the low of the candle. So this is a buy order. That's my stop loss. And again, when you learn when we go into strategies, you notice that you can't just buy when you see a one white soldier after a sell-off, right? It has to again coincide with some oversold condition, right? Stochastic should be below 20, or the price is hitting a lower Bollinger Band, something that tells us that it is oversold, is ready to bounce back up, okay? And we'll take the trade as it goes up again, okay? So that's your one white soldier pattern. Now, some of you may say, hey, isn't this a one white soldier? Bearish candle followed by bullish candle, right? No, it's not, right? Doesn't meet the criteria because the bullish candle makes a lower low than the bearish candle. So that breaks the rules already. So that is not a one white soldier. It's good. So it's going to be really specific to meet the rules. Yeah. Great. So the opposite of the one white soldier is the one black crow. Okay. So the one white soldier is a bullish pattern going up. The one black crow is a bearish pattern. It's a bearish reversal pattern. So we will look at it, we'll see it after a series of candles going up. So what we want to see in this pattern is the price is going up. Okay. So bullish candle, bullish candle, bullish candle, bullish candle. And the last bullish candle after a series of bullish candles is known as the, that's right, swing high, right? The swing high candle. So this is a swing high candle. So this represents this, okay? So buy, 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 buy. And right after that bullish candle, we want to see a bearish candle, like so. Okay, so the one black crow, again, is made up of two candles. A bullish candle at the top of an uptrend, okay, followed by a bearish candle. Now, for it to qualify as a one black crow, it must meet, again, certain criteria, all right? So bullish candle followed by bearish candle. First, the bearish candle must open below the close of the bullish candle. That's the first criteria. So again, recall this is the open of the bullish candle. That's the close. This is the high. This is the low, right? This is the open of the bearish candle. That's the close. That's the high. And that's the low, right? So criteria one is the bearish candle has to open, this is the opening price, below the close of the bullish candle. So that is the first criteria that must be met. Second criteria, the bearish candle must make a lower high than the high of the bullish candle. So this high has to be lower than this high. Check. Next, the bearish candle must close below the low of the bullish candle. So this close has to be lower than the low of this bullish candle. So once again, all three criteria are met, you have a one black crow pattern. And there's a high chance the price will reverse down. And again, when is the best time for this to appear? We want it to appear at a resistance level of a downtrend, right? So a rally, resistance, one black crow, short it, follow the trend as a trend trade. Or we find this at the top of an uptrend. So it's an uptrend, it's overbought, it's overstretched, one black crow, do a short, and we write a counter trend trade down. Okay? So again, what is the psychology behind this? The psychology is, right, as people are buying, right, they're buying, they're pushing the price up, and they're buying, right? So these guys are buying, hoping it's going to go higher the next day, right? But the next day, what happens? The price opens below the close of this candle, which means all those traders who bought at the close find that they're losing money because now it's lower than where they bought. So what do? They panic, right? And they quickly sell to cover their position. And by selling, they create more bearishness. So the price goes down, and closes below the low of this candle, which means that anyone who bought on this day, right, hoping it's going to go up, they are now screwed because the price is lower than where they bought it, right? So what happens, right? So they quickly want to sell to get out, right? So by selling, what happens? It creates more selling pressure, and the price goes all the way down. And so that's the psychology of the one black crow. That's why it turns bearish. So let's see where it appears again on the charts. All right. So what we have here is we have a downtrend. Okay. You can see clearly it's a downtrend. The moving averages are sloping down. The 50 moving average is below the 150, clear downtrend. Down, retrace, boom, one black crow. Can you see that? And the one black crow is hitting the moving average, okay? So like I said, you always want to see the candlestick pattern interacting with the moving average, or interacting with some kind of resistance or support to give it added confluence. Okay, so we've got a one black crow. There we are. Very nice. One black crow. What do we do? Put a sell order over here. Stop loss over there. Short here. Stop loss over here. So the next day it goes down, triggers our sell order, and sure enough, we're in the trade and we get an easy 1 to 2 risk to return ratio on this trade. So this is a trend trade. We're trading with the trend, selling at the rally on the downtrend with a one black crow hitting resistance. Okay. This is another trend trade. All right. Uptrend, as you can see, the 50 moving average above the 150, price above the moving average. So you can see it's up, and you see a retracement to the moving average, and boom, one black crow. One black crow. Yeah, one black crow. Sorry. Where's the one black crow? Where's the one black crow? Okay. Ignore what I just said. That was not one black crow. Okay. Can you find the one black crow? There we are. One black crow. Okay. So price goes up, and again, we see a bullish candle. After a series of bullish candles, we see a bearish candle. And the bearish candle opens below the close of the bullish candle. Check. Bearish candle makes a lower high than the high of the bullish candle. Check. Bearish candle closes below the low of the bullish candle. Check. Check, check, check. One black crow. All right. And again, it appears at the top of the uptrend. So ideally, at that point, we want to see some kind of resistance. Okay, like cutting the upper Bollinger Band, stochastics overbought, something to tell us it is overbought, is hitting resistance. Okay. And once we are confident, we can put a sell order over here. Oops. Sell order over here. Stop loss over there. Okay. Entry over here. Stop loss over here. The next day, it hits our entry and we are in the trade on the way down. So notice this is a counter trend trade. We are selling against the uptrend because we think it's overbought, it's going to retrace down, and we see a one black crow pattern. All right, so from pin bars to one white soldier, one black crows, let's now go to the morning and the evening star. Again, this is a pretty common pattern, but very reliable. The morning star and the evening star are the bullish and bearish equivalent. So let's begin with the morning star. Okay, so the morning star is a bullish reversal pattern, and the evening star is its counterparty bearish reversal pattern. So the morning star appears at the bottom of a downtrend or the bottom of a retracement. Okay, and it consists of 3 candles, right? 3 candles. The first candle should be a long bearish candle, which is at the end of a sell-off, right? So you got bearish candle, boom. You've got that last bearish candle. We'll call that candle 1, okay? Now, after that bearish candle, the second candle should be a small candle. Let me say, how small is small? Well, small in relation to the previous candle. So when you see like these huge candles with really big bodies, and then you see a candle of a small body, right? And small shadows, okay? And this small candle could be a bullish or a bearish candle, doesn't really matter, okay? The color doesn't matter because the candle body is so small that whether it's red or green, it's pretty insignificant. But we want it to be a small candle of indecision. Ideally, it should be a doji. Now, what's a doji? A doji is a candle where the open and the close are the same price. So you've got one line representing the body. That's called a doji. And the upper and lower shadows are the same length, right? So dojis represent indecision, like I don't know where I'm going, right? So bullish is like, okay, I'm going up, bearish, I'm going down. Dojis, I'm undecided. So you want to see kind of like a doji candle over here. Now, following the doji candle, you want to then see a bullish candle, okay? So a strong bearish candle. After that, it's got to have a small gap. right? You want to see a small gap between the price. You have got that small candle and then another small gap, boom, you've got that bullish candle. And the bullish candle should close above the half the body of the bearish candle. So what does it mean? So if you take the entire body of the bearish candle and say you take it 100%, this should close above the 50% level of that candle, above half the body, right? So when you see that, that's a pretty reliable reversal pattern. So we could put a buy order a few cents above that bullish candle, and you could put a stop loss either below that bullish candle or below that doji candle, right? And again, what is the psychology behind this working? Because what you see is you see bearish candles, which means their sellers are selling, 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 and then it gaps down. But then what happens on this day? The selling stops, right? It doesn't go down anymore. But then again, it doesn't go up as well. So it's like an indecision candle, a fork in the road. Okay, something's going to change, right? And then you gap up with now a bullish candle. So now the bulls have taken over, and we expect retracement to the upside or change in trend. Okay. The evening star is the opposite. So the evening star is a bearish reversal pattern that appears at the top of an uptrend or the top of a rally, right? So you've got a series of bullish candles, and the last bullish candle is your candle one. And then it gaps up to a small candle, all right? So long bullish candle, gap up to a small candle, and then it gaps down to a bearish candle that again should close below the 50% mark of the bullish candle. So when you see this combination of three candles, bullish candle, gap up, small candle, gap down, bearish candle, evening star, you can place a sell order over here with a stop loss either here or here. All right. So let's see how they appear on charts. So what we're seeing is we're seeing an uptrend. All right. We've got an impulse, retracement, impulse, retracement. Okay, and there you go. There you have got a morning star. So the morning star appears at at the end of a sell-off. In this case, at the end of a retracement. Okay, and it appears at the support of a moving average. So again, candlestick pattern should always coincide with moving averages or trend lines or support and resistance. Yeah. So you got a bearish candle, gap down, small candle like a doji, gap up, bullish candle, boom, reversal going back up again. Yeah. Okay. Can you spot the morning star? Give yourself a few seconds. Can you spot a morning star? So again, a morning star is a bullish reversal pattern. So bullish means at the end of a sell-off, it appears reverses. Right? Can you spot it? Over here, right? So sell-off, there you go. That is your morning star. Okay? So you got your candle one, your bearish candle, gap down to a, well, this is not an ideal small candle because it's got a pretty long upper shadow. Ideally you want the upper and lower shadows to be the same length, but it is a small body. I give it that to you. So it's not ideal, but I'll pass it, right? And it gaps up to a bullish candle that closes above the 50% mark. Now, what I like about this is you can see the stochastics is oversold, right? It's below 20. So it's telling me that it's oversold due for a bounce. And it's also cutting the lower Bollinger Band. So this tells you that it's oversold at a support level. It's got a morning star, confluence of candlesticks and support levels. So boom, goes up, right? Take a trade, long trade. And you can see this is a counter trend trade because you're trading against the downtrend, right? All right, this is an evening star pattern. Can you spot the evening star? That's right, it's over here. Very nice evening star, okay? So you can see that the price goes up, retraces, goes up to an overbought condition. Why is it overbought? Because it pierces the upper Bollinger Bands. So the upper Bollinger Bands act as a resistance. Remember that? And the stochastics is overbought. It's above 80. Overbought resistance. Got to come down, right? So there you see candlestick pattern, right? Bullish candle, gap up, small candle, body, okay, gap down, boom, big bearish candle, and we see a reversal all the way down, okay? All right, let's look at our last set of candlestick patterns, which is the engulfing patterns. First, the bullish engulfing and the bearish engulfing. So the bullish engulfing is a set of two candles that is made up of a small bearish candle, right? Small bearish candle, followed by a huge bullish candle that engulfs the body of the bearish candle. So what is engulf? Engulf means like to swallow, right? So you want this bullish candle, the body, to be bigger than the body of the bearish candle. So imagine this is like a mouth, right? So this mouth is able to swallow the entire piece of red meat, if you call it, right? Okay, so the bullish engulfing pattern appears at the end of a downtrend or at the end of a retracement. So what you want to see is you want to see a series of bearish candles going down. Okay, so bearish candles, and that is the last bearish candle you see, which is a small bearish candle. Okay, and then following that, you want to have a really big bullish candle that engulfs it, right? So once you have that, there's a high probability the price will reverse back up. So that's when we go long, right? Again, we put a buy order a few cents above the high of this candle and a stop loss below the low of this candle, right? And that would be our 1 hour risk. The bearish engulfing pattern is the opposite. So it consists of a small bullish candle, which is then engulfed by a large bearish candle. Okay, so again, you've got a small candle body, and the bearish candle is engulfing it, right? Bigger than that, right? So in other words, this is kind of like contained within this entire candle. So this appears at the top of an uptrend, okay, or the top of a rally, right? So prices are going up. You see that small bullish candle, and then boom, a big bearish candle reverses down. So you can put a sell order over here, okay, and a stop loss over there. Let's take a look at the charts. All right. So can you find any of the engulfing patterns? Take a couple of seconds, see if you can spot it. And again, we want the candlestick pattern to ideally be coinciding with the moving average support or resistance. Okay? So there you go. That is a very clear bullish engulfing, right? So price comes down, right? Retraces, boom, you see that small bearish candle followed by a huge bullish candle engulfs it just at the support level of the 50 moving average. Okay, so buy order over there, stop loss over here. Next day, bam, gets triggered, boom, we're up, and we get our 2 hour target pretty easily. Okay, retraces back again, and boom, you have another bullish engulfing pattern. Boom, goes up again, comes down. That's a bullish pin bar. Boom, goes up again, right? So these candlestick patterns are pretty cool. Now, I don't particularly like this one because you can see that it is a bullish engulfing pattern, but it is not at some kind of support level. Ideally, you want it to be at a support level, like a trend line or moving average. This one is like, you know, it's appearing somewhere there in between nowhere, right? It still works, but ideally, again, I want to see a support level, right? Okay, so those are engulfing patterns. So to summarize, when do we use candlesticks? Remember, candlestick patterns must always be analyzed in the context of the price trend. All right, so what's the trend? Is it an uptrend? Is it a downtrend? Is there a support? Is there a resistance level? Okay, so we only go long when we have a bullish candlestick pattern that appears at the support of an uptrend. That means at the dip of the uptrend, or at the bottom of the downtrend when extreme oversold conditions are met. And that would be a counter trend trade. So again, if you take a look at this example, this is an uptrend, right? Price is on the uptrend with this very nice wave pattern, right? So impulse, retracement, impulse, retracement. And the ideal time is we want to see the bullish candlestick pattern appearing at the retracement, right? At the end of the retracement, it appears at the support level, like a moving average or a trend line, and we'll buy to follow the trend. So this would be a trend following trade. Or in this case, you can see it's a downtrend, right? So downtrend, and it's right at the bottom of the downtrend where it is oversold, right? So stochastic is oversold at the lower Bollinger Bands, and we expect it to, that's right, retrace back to the moving average. And that would be a long pattern, which is a counter trend trade when we see a bullish candlestick pattern. Similarly, when do we go short when we see bearish candlestick patterns? We only go short when a bearish candlestick pattern appears at the resistance of a downtrend. Okay, so you can see a downtrend over here, right? So impulse, retrace, boom, bearish candlestick pattern appears right at the resistance level, right at the moving average. And that's when you sell to continue riding the trend down, trend trade. Or the bearish candlestick pattern appears at the top of an uptrend. Okay, so in this case, it's an uptrend, right? Impulse, retracement, impulse, all the way, it's overbought. Boom, bearish candlestick pattern appears at an overbought condition. So again, you want to see hitting the upper Bollinger Bands, or stochastics overbought, for example, and you do a short, right? Counter trend short, do a quick short, make some money when it comes down, and quickly cover your short position before it continues going up. All right, so this concludes this section on candlestick patterns, and I'll see you in the next section.